The silver market has entered one of its most fascinating periods in years, not because prices are making headlines every day, but because some of the most important shifts in financial history often begin when the majority of investors are looking somewhere else. Markets rarely announce their biggest opportunities with obvious signals. Instead, they develop quietly beneath the surface as economic forces, monetary policy, investor psychology, and global demand gradually align. Silver now sits at the center of that convergence. While many participants continue watching short-term price fluctuations, the broader picture reveals a metal influenced by forces far larger than daily trading activity. Every decision made by central banks, every movement in Treasury yields, every inflation report, every shift in the US dollar, and every new investment in advanced manufacturing has the potential to reshape silver's outlook. That is why understanding silver today requires looking beyond simple price charts and examining the economic machinery driving global capital flows. Over the last several years, inflation has transformed from a temporary concern into a defining economic challenge. Although headline inflation has moderated from its highest levels, policymakers remain cautious because underlying price pressures have proven more persistent than many initially expected. The Federal Reserve continues balancing two competing objectives, keeping inflation under control while avoiding unnecessary damage to economic growth. Every interest rate decision influences borrowing costs, corporate investment, consumer spending, and ultimately investor appetite for assets that serve as stores of value. Higher interest rates generally increase the opportunity cost of holding precious metals because they do not generate income, yet history repeatedly shows that the relationship is rarely that simple. Real interest rates, inflation expectations, and confidence in monetary policy often matter far more than the nominal policy rate itself. Investors increasingly recognize that even when inflation appears to cool, structural factors including government spending, demographic changes, supply chain adjustments, and geopolitical fragmentation can keep price pressures elevated over longer periods. In such environments, silver often attracts renewed attention as both an industrial commodity and a monetary asset. Unlike many other metals, silver occupies a unique position within the global economy. It serves manufacturers building advanced technologies while simultaneously attracting investors seeking diversification during periods of financial uncertainty. This dual identity creates market dynamics unlike almost any other commodity. Industrial demand can strengthen during periods of economic expansion, while investment demand often rises when uncertainty increases. Occasionally, these two forces reinforce each other, creating powerful momentum. At other times, they move in opposite directions, producing periods of consolidation that challenge both bullish and bearish expectations. Understanding which force dominates at any particular moment requires constant evaluation of economic data rather than emotional reactions to short-term volatility. The US dollar remains another critical variable. Because silver is typically priced in dollars, movements in the currency frequently influence international purchasing power. A stronger dollar can create temporary pressure on precious metals by making them more expensive for foreign buyers, while a weaker dollar often provides support by improving affordability across global markets. Yet currency movements themselves depend on expectations surrounding interest rates, economic growth, fiscal policy, and international capital flows. If investors begin questioning the long-term purchasing power of fiat currencies or become concerned about expanding government debt, demand for tangible assets can strengthen even in environments where interest rates remain elevated. Treasury yields offer another valuable window into market expectations. Rising yields often reflect stronger growth expectations or tighter monetary policy, while falling yields may signal slowing economic momentum or increasing demand for safe assets. Silver does not respond mechanically to every yield movement, but sustained changes in real yields frequently influence institutional asset allocation decisions. Large investment funds continuously evaluate relative opportunities across equities, bonds, commodities, and alternative assets. When the balance of risks shifts, portfolio adjustments can significantly affect precious metal demand. Institutional positioning deserves close attention because major market participants often move gradually rather than dramatically. Instead of attempting to predict exact turning points, they frequently build exposure over extended periods, while liquidity remains favorable. Retail investors, by contrast, often become most interested after strong price advances have already attracted widespread media attention. This difference in behavior has characterized financial markets for decades and continues to influence sentiment today. Industrial demand represents one of silver's most compelling long-term characteristics. The global transition toward cleaner energy systems has increased the importance of technologies that rely on silver's exceptional electrical conductivity. Solar panels, electric vehicles, advanced electronics, telecommunications infrastructure, and semiconductor manufacturing all require varying amounts of the metal. While technological innovation sometimes improves efficiency and reduces silver usage per unit, overall production growth across these industries can still support robust aggregate demand. Manufacturers also face challenges securing reliable supply chains as geopolitical tensions encourage greater regional diversification of production. These structural developments extend well beyond short-term economic cycles and may influence the balance between supply and demand for years to come. Supply itself introduces another layer of complexity. Developing new mines requires substantial investment, regulatory approvals, environmental assessments, and years of construction before meaningful production begins. Many silver mines also produce the metal as a byproduct of mining for other commodities, meaning silver output may depend partly on conditions affecting entirely different markets. This limits the industry's ability to respond rapidly to unexpected increases in demand. Investors therefore monitor exploration activity, capital expenditures, recycling trends, and mining costs, alongside traditional macroeconomic indicators. Geopolitical developments continue adding uncertainty to the global investment landscape. Trade disputes, regional conflicts, sanctions, shipping disruptions, and changing alliances can all influence commodity markets through their effects on energy prices, manufacturing activity, and investor confidence. During periods of heightened uncertainty, diversification often becomes more attractive, encouraging some investors to increase allocations toward precious metals. However, geopolitical events rarely produce uniform outcomes. Some developments may strengthen industrial demand while simultaneously weakening broader economic growth, creating mixed signals that require careful interpretation rather than simplistic conclusions. Another important measure watched by experienced investors is the gold-to-silver ratio, which compares the relative prices of the two metals. Historically, this ratio has fluctuated considerably across different economic environments. A high ratio has sometimes coincided with periods when silver appeared relatively inexpensive compared with gold, although history never guarantees future performance. Rather than serving as a precise forecasting tool, the ratio provides context regarding market preferences, investor sentiment, and relative valuation within the precious metals sector. Exchange-traded funds, futures markets, and options activity further illustrate evolving sentiment. ETF inflows may indicate growing long-term investment interest, while futures positioning reveals how speculative participants are responding to changing expectations. These indicators should never be viewed in isolation, because positioning can reverse quickly when new economic information emerges. Instead, they become more meaningful when combined with broader trends in inflation, monetary policy, industrial production, and currency markets. Investors should also remember that silver is historically more volatile than gold. Sharp rallies and equally sharp corrections have occurred throughout previous market cycles. Volatility alone does not confirm either strength or weakness. Instead, it reflects the market's ongoing process of incorporating new information into prices. Emotional reactions often amplify these swings as fear and optimism compete for dominance. Successful long-term investing generally depends less on predicting every short-term fluctuation and more on maintaining disciplined risk management aligned with clearly defined objectives. Bullish scenarios for silver typically involve a combination of moderating real interest rates, resilient industrial demand, stable or weakening dollar conditions, and renewed investment flows seeking portfolio diversification. Continued expansion in renewable energy infrastructure and advanced manufacturing could reinforce those trends if global economic growth remains sufficiently strong. Bearish scenarios, however, cannot be ignored. A sustained period of restrictive monetary policy, unexpectedly strong real yields, slower industrial production, or declining manufacturing investment could reduce demand while encouraging investors to favor income-generating assets. Neutral outcomes remain equally plausible if opposing forces largely offset one another, leading to extended periods of consolidation before a clearer trend eventually develops. History demonstrates that financial markets often spend significant time moving sideways while participants reassess changing economic conditions. Patience can therefore be just as important as conviction. Investors frequently underestimate the role psychology plays in market behavior. Confidence tends to rise after prices have already advanced, while pessimism often becomes strongest near periods of maximum uncertainty. Recognizing this tendency does not eliminate risk, but it encourages more thoughtful decision-making. Rather than reacting to headlines alone, disciplined investors evaluate whether new information genuinely changes the long-term investment thesis or merely contributes to temporary volatility. As global economies continue adapting to technological transformation, demographic shifts, evolving trade relationships, and changing monetary conditions, silver will likely remain an important asset to monitor. Its combination of industrial relevance and monetary history gives it characteristics unlike most other commodities. Whether prices ultimately move higher, lower, or remain range-bound over the coming months will depend on a complex interaction of macroeconomic data, policy decisions, corporate investment, consumer demand, and investor expectations. Certainty is never available in financial markets, but informed analysis allows participants to make decisions based on probability rather than emotion. That is why staying informed matters more than chasing predictions. If you found this analysis valuable, share your perspective in the comments and consider subscribing for more in-depth discussions on precious metals, macroeconomics, and global markets. And as always, remember that this content is provided for educational and informational purposes only and should not be considered personalized financial or investment advice. Always conduct your own research and consult a qualified financial professional before making investment decisions.